In the United States, there are about $1.3 trillion in auto loans outstanding. By the end of 2018, 4.5% of the total balance outstanding were 90 days or more delinquent. This is the worst delinquency rate since the first quarter of 2012, coming out of the Great Recession. And more disconcertingly, the delinquency rate is on par with Q2 2009. Back then, it was shooting higher as millions of people had lost their jobs, as the stock market had crashed 50%, after Lehman had gone bankrupt, all heck had broken loose in Q2 2009, and that's when auto loan delinquencies reached 4.5%, same as now. But now the labor market is considered strong. Over the past 12 months, unemployment has ranged between 3.7% and 4%. The economy grew at about 3% last year. So the surge in auto loan delinquencies to these enormous rates, where 7 million people are now delinquent on their car loans. This is really baffling the industry. What is causing this? Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. It's Sunday, February 17th, 2019. This surge in default rates can be explained in different ways. One, a lot of people are struggling with their jobs. While the unemployment rate currently is at around 4% and has been as low as 3.7%, there are many pockets of weakness in the labor market. A lot of people have gig work. A lot of people are underpaid. Their wages have not gone up with inflation. People have been discouraged and they're not participating in the labor force anymore. And so they don't show up in the unemployment figures. So there are many weaknesses in this labor market. But looking back over the past 18 years, this is the strongest labor market I have seen. It's the cleanest dirty shirt of the labor markets we've had. But over the past 3 years since the default rates on auto loans have started to surge, the labor market has not deteriorated. In fact, it has gotten a little stronger, and quite a few more people have found jobs, and some of the wages have gone up. So the labor market itself cannot explain why these auto loans have started to default in such large numbers. A second possibility might be the price of vehicles. The average transaction price for a new vehicle these days runs at around $36,000. That is significantly higher than before. Wages have not really gone up that much, and it puts a larger burden on buyers. Subprime buyers have a particular handicap. They pay much higher interest rates generally than prime buyers because they represent a larger risk, and lenders want to make more money knowing that the default rates will be higher and that they will lose money on some of those loans. Subprime customers pay for these higher priced vehicles with loans that have high interest rates, and so they pose a larger burden on their monthly incomes, and it doesn't take all that much to push this situation beyond the limit. Now, then there's a third possibility here, and this is probably a lot more significant. In 2014, a number of specialized subprime lenders plowed into this business. Subprime lending is extremely profitable. You can charge very high interest rates. Customers have been turned down by regular lenders, by captive lenders, by banks, by credit unions. So they're at the end of the rope, and they want to buy a new car, and the dealer says, yeah, we can get that financed. It'll be with this lender here, and the payment will be this amount, and sign here. And what they're signing is a loan that costs maybe 12% in interest and has a very high payment, but they qualified for it. And this is a very profitable loan for subprime lenders that specialize in this, even though it's a very risky loan, because these are precisely the kind of customers that cannot afford those payments, and that cannot afford to make those payments based on high interest rates, and that can't even afford that expensive of a car. And when we look at the subprime delinquency chart, we see that it sort of bottomed out in early 2014, coming out of the Great Recession. But it bottomed out above 3%. And in the prior periods, the low end overall auto loan delinquencies was around 2%. So it ranged between 2 and 3% during the good times, and then it shot up past 4% to 5% or higher during the financial crisis. In this cycle, they never dropped below 3%. the delinquency remained above 3%. And in 2014, that bounced off of about 3.2% and started going higher. And this is when the auto subprime lenders started going into this business big time. Many of them were backed by private equity firms. They're smaller companies. They specialize in subprime loans. Many of them do practically only subprime loans. Some of them have 90% of their loan book in subprime. And they operate on a principle where they try to spread the risk. They borrow money from a bank. They borrow maybe $1 billion from Bank of America. And then they write these loans to subprime rated customers, very risky loans. The underwriting can be sloppy. They're really not that interested in the long-term outcome of these loans. And then they package those loans together in asset-backed securities. So there'll be auto loan-backed securities, and they sell them. And these securities get sold all over the world. They end up in pension funds in Europe and in Japan and in California, and so the risk gets spread. They retain some of the risk, but it's relatively small. These lenders went out there in this very profitable business, and they got very aggressive in 2014 and in 2015 and in 2016, and then suddenly they realized that these new generation of loans were defaulting at a very significant rate. By 2018, several of these specialized subprime lenders already collapsed, and more of them are in trouble now. They have started curtailing the lending. When you get aggressive in a market like this, and when you start ignoring risks, you're going to have high delinquency rates. And that's what we're seeing. The delinquency rates are particularly focused at these specialized lenders. But it's not like subprime loans are only extended by specialized subprime lenders. It's a profitable business for all types of lenders. Among the biggest banks being 6 of them with over $500 billion in assets, for these big banks, about 25% of the loan book is subprime. For credit unions, which are just behind the big banks in terms of the total number of auto loans, 14% of the loans are subprime. For the captive auto lenders, 19% of the auto loans are subprime. But their underwriting standards are pretty high. And while they finance vehicles to customers with a credit score of less than 620, they will do careful search on their backgrounds, on their incomes. They will verify income, and they'll practice good underwriting standards. And so their subprime lending is in reasonably good shape. Now, then there are the specialized subprime auto lenders, and on average, 50% of the loans are subprime rated, and with many lenders, this is much higher and can be as high as 90% or nearly 100%. And that's where these defaults are occurring, but this is a relatively small segment of the industry. These specialized lenders only hold about $150 billion worth of total auto loans, which is a fairly small portion of the $1.3 trillion in outstanding auto loans. These specialized lenders will not take down the financial industry. When these smaller subprime lenders collapse, they will spread some pain around, and the big banks will take some losses on the loans they've extended to these subprime specialized lenders, but it will not take down the financial industry. The big banks can digest losses they have on their subprime loans. In total, the industry can digest those loans. If you do the math a little bit, there are $270 billion in subprime loans outstanding. If 50% default, that would be $135 billion in loans. If the loss ratio is about 50%, now you're in the $60 billion range spread over all the financial institutions in the United States, with a good portion of them carried with smaller specialized subprime lenders. So the big banks will take some losses, but it will not damage them to the point where they start sinking. Auto loan subprime is not a question of whether the financial system will go down or not. It's a different question. It's a question of what will happen to the auto industry, to auto sales. And that's where we have seen the impact already. For the industry overall, 2016 was a record year. For American automakers, so that's Ford, General Motors, and Fiat Chrysler, 2015 was the record year. Since then, every year has been a down year, in part because the subprime default ratios have been spiking and lenders have become more careful with the new loans. So underwriting standards have tightened up. Some of the more aggressive subprime lenders have collapsed. And it's more difficult for customers now to obtain a loan when the credit score is below 620, and when their income can't be verified, and when they have other issues, when they have tarnished credit records of some sort, and now they're having trouble getting a loan for a new vehicle, and this has hurt new vehicle sales. So I'm not worried that subprime loans will take down the financial industry. I'm not worried that these default rates will cause such losses that the big banks topple. There will be losses, but the losses will be scattered around. There are already losses, but these losses so far have been digestible and will continue to be digestible for the larger players in the U.S. financial industry and among the pension funds and the like that own these asset-backed securities. However, as auto loan delinquencies continue to surge and as losses are spreading, underwriting will continue to tighten and will make it more difficult for an entire layer of customers to buy new vehicles. When you think about it, 23% of all outstanding auto loans are subprime. And when a large portion of this 23% gets cut off from credit, it has a significant impact on vehicle sales. Now, these customers are still going to buy cars. You need to have a car in most cities to buy groceries and do things that you normally do in life. So they will buy cars, but they will not buy new cars. They'll be locked out of the new car market, and they will switch to used cars, possibly the lower end of the used cars where they can pay for in cash that they scrounge up from perhaps their parents. So this is a loss to the new vehicle market. As these default rates rise, more people will get locked out of the market, and the automakers will feel that in a painful way. Now, that is the rosy scenario. The rosy scenario means that there are no job losses, that the labor market continues at about the same rate where it is now, that the economy continues to grow. The less rosy scenario is where there are millions of job losses, as you might see in a major recession, and suddenly not only subprime rated customers will default on their vehicles, but also prime rated customers that have lost their jobs and that were living from paycheck to paycheck, and suddenly they cannot make the car payment anymore. In this scenario, the losses will be greater to the financial industry, but it will really hit the automakers because suddenly these default rates will prevent an entire layer of customers to purchase a car. And we have seen that during the last recession. There's a steep decline associated with increasing job losses that the automakers feel in a very, very painful way. Ladies and gentlemen, this is Wolf Richter of WOLFSTREET.com. Thank you for listening to the Wolf Street Report.